At first glance, global storage data appears comforting. Billions of barrels sit in tanks, pipelines, and tankers worldwide. But here's the critical distinction. Stored does not mean available. Oil infrastructure is like a circulatory system. Pipelines must stay pressurized. Refineries need constant feed. Storage facilities cannot be drained below safety levels. Governments hold strategic reserves that cannot be tapped casually. What looks like surplus is, in reality, a system operating close to its minimum safe threshold. Industry analysts refer to this as the operational floor, the level below which the system cannot function normally without risking widespread disruption. And current drawdowns are pushing inventories closer to that floor at a pace rarely seen outside of wartime conditions. To understand why this is happening, we have to look at geography. The Strait of Hormuz is one of the most critical maritime passages on Earth. Roughly 1/5 of the world's oil moves through this narrow corridor each day. When tensions escalate in this region, it doesn't just affect one country, it affects the energy supply chain of the entire planet. Reduced tanker movement, constrained exports from major Gulf producers, and shipping insurance complications have combined to slow the flow of crude through this artery. When supply routes tighten, the world turns to stored oil to compensate. And that's exactly what has been happening. Interestingly, global oil consumption has already declined sharply in response to higher prices and uncertainty. But here's the problem. Inventories are still draining faster than demand is falling. This is the hallmark of a physical supply shock. In past economic crises, falling demand allowed inventories to rebuild. This time, both are happening simultaneously. Demand is weakening while stocks are being depleted. That combination is rare and dangerous. Oil is not useful in its raw form. It must be refined into gasoline, diesel, jet fuel, and petrochemicals. Refineries operate on tight margins and continuous flow. When feedstock becomes inconsistent, outages occur. The first warning sign of this stress is often not crude prices, but diesel markets. Diesel fuels trucking, agriculture, construction, shipping, and manufacturing. When diesel supplies tighten, supply chains begin to fracture. This is how an energy issue becomes a goods shortage issue. Inflation rises because of energy, but slowing the economy further to fight that inflation risks deep recession. This creates the conditions economists dread most: stagflation, high prices, and low growth at the same time. And monetary policy becomes trapped. Energy-intensive industries are the first to feel pain. Airlines, logistics firms, manufacturers, chemical producers. When fuel costs surge while borrowing costs remain elevated, margins collapse. Historically, this is when bankruptcies begin to surface in waves across sectors that depend on cheap energy and cheap credit. Financial markets do not wait for news anchors to confirm trends. They reprice ahead of consensus. In previous energy shocks, equity markets, bond markets, and commodities adjusted months before the public understood why. Watch energy futures. Watch transport stocks. Watch industrial metals. These often move first. During stagflationary periods in history, investors seek assets that are not tied to economic growth or currency stability. This is where gold and silver historically re-enter the spotlight, not because of hype, but because persistent inflation combined with policy paralysis erodes confidence in paper assets. Hard assets begin to look like insurance. Over the coming weeks, several signals will reveal whether this stress is accelerating or easing. Weekly inventory reports from energy agencies, diesel refining margins, tanker traffic through Gulf shipping lanes, central bank commentary on interest rate flexibility, performance of mining and energy equities. These indicators often tell the story before official reports do. Large financial institutions rarely publish worst-case operational scenarios without reason. These reports are designed to prepare major clients for risks that are no longer theoretical. When such institutions begin modeling extreme outcomes, it signals that tail risks are moving closer to reality. What we are witnessing is not just an oil story. It is a story about how interconnected the global system has become, and how a disruption in one choke point can ripple across inflation, industry, finance, and daily life. Energy is the foundation beneath everything else. When that foundation wobbles, everything above it feels unstable. We are at a moment where multiple forces are converging. Physical supply constraints, geopolitical tension, inventory depletion, economic slowdown, monetary policy limitations. Whether this resolves quickly or escalates will determine how severe the consequences become. But the warning signs are now visible to those who know where to look. And history shows that when energy markets reach their limits, the effects are rarely contained to gas stations alone. They reshape economies, they reshape markets, and they reward those who understood the signals early. Stay informed, watch the indicators, and understand that this story is still developing, quietly, but rapidly. Because the next few months in global energy may define the next few years in global economics. Higher transport costs push up the price of everything: food, electronics, clothing, materials. Central banks then face an impossible situation.